So my name is Scott Gonsoulin. I am with Texas Teachers. We are a $150 billion pension plan down in Austin, representing 1.6 million active and retired teachers. Today, I want to talk a little bit about how our organization is thinking about active management and passive management. Before I do, I want to do a high-level overview of our asset allocation at Texas Teachers. So as you can see on the chart, our trust has about 60% of its assets allocated to global equity. These are assets we would expect to do well during normal, healthy economic environments like public equity, private equity, certain hedge funds. We have about 20% of our assets in what we call stable value. These are assets that should do well in an economic downturn, include things like treasuries, cash, and certain market neutral hedge funds. We've got about 20% in what we call real return. These are strategies that should do well in an inflation surprise, like real assets, tips, commodities. And we have a small allocation to risk parity. So as you can see from the chart, the short answer to the active passive question at Texas Teachers is that we are heavily skewed towards active management. About 80% of our assets are managed actively. And the only material allocations that we have to passively managed strategies are our treasury portfolio and our tips portfolio. And then as you can see in blue, there's a small slug of public equity that's passively managed. But that's really functioning as a placeholder right now. So even though Texas Teachers, clearly from this graph, is very heavily skewed towards active management, over the last 2 years, we've had a little bit of evolution in our thinking around active and passive. And I want to talk a little bit about the beliefs that underlie some of the changes and some of the changes that we've made. So first, belief number one, and this shouldn't be surprising after the presentations that we've heard. At Texas Teachers, we believe active management works, but it works better in some places than others. So these charts, again, not super scientific, kind of probably similar to what David did, take the median 3-year excess return, this is gross of fees, of US large cap managers, and the median 3-year excess return of developed international managers. So for example, as of December 2017, the median US active manager was underperforming its benchmark by about 35 basis points per year, gross of fees, over the last 3 years. Over the same time period, the median international developed manager was outperforming its benchmark by about 100 basis points a year for the last 3 years. As the chart shows, the excess returns of IFA managers over the excess returns of US managers have been pretty consistent through time, particularly since the financial crisis. And in fact, if you were to just pick a random IFA manager from this data set after the financial crisis, you have about a 75% chance of outperforming the benchmark. For the US managers, that's 47%. Again, these are gross of fees. We'll probably explain some of the difference between me and David's numbers. But my team would like to believe that we're a little bit better than picking the random manager. If not, we probably shouldn't have our jobs. But it is helpful to know when the odds are on your side and to know which geographies and which types of strategies might be a little bit more supportive of active management. So that's kind of belief number one. When we examined our own internal results, we found a similar thing to be true. So this shows the 5-year alpha of TRS public equity portfolios. So you've got our external managers, my team, internal fundamental managers, and internal quantitative. And as you can see, managers operating in international developed, which is IFA, and emerging markets, were generating excess returns at or above their target levels. They were doing great. When you look at the US, the external managers, which is my team, and the internal fundamental team, candidly were generating terrible results. And so like I said, we not only find this to be true in the broader universe of managers, which is that previous slide, we found this to be true when we looked at our own performance and our own results. I'll show you one more chart at the risk of beating a dead horse, but this is some work that an external partner of ours, Man Group, did. And it essentially finds the same thing is true in hedge funds. And that is that after you adjust for equity beta, the median US hedge fund doesn't generate any alpha, whereas the median European hedge fund is generating about 40 basis points a month. So why is this the case? We don't know. You guys have heard some theories on this up here. My personal belief is that the US market is a little bit more efficient, that you have a lot more people looking at that market. And when you have that much more competition, the average returns go down. But maybe me and David will have a debate on that later. That's a lightly held theory. The point was, for us, we empirically found that active management wasn't working in the US. And even if we didn't know how to explain it, we had to acknowledge that that was the case. All right, so the next belief is that there are risk factors that generate excess returns and that our portfolios should be positively exposed to them. So on the chart, you see 3 risk factors that are pretty widely believed to produce positive excess returns: value, momentum, and quality, also known as defensive. Each of them has a positive Sharpe ratio between 0.5 and 2. Not a bad correlation matrix there. Value is diversifying its momentum. It's uncorrelated to quality and defensive, and quality and momentum have a modest positive correlation. Put them all together and you get a pretty nice looking return profile. Now, can you build a factor portfolio that captures that return exactly? It's very doubtful, but can you be intentional about leaning into these factors and being positively exposed to them so that you benefit from them instead of betting against them and having them detract from your performance? Absolutely. And at Texas Teachers, we're able to do that with our internal quantitative team. And one of the punchlines to this presentation is that the closest thing that you'll find in TRS public equity portfolio to passive management are internally managed factor-based smart beta strategies that provide us with access to value, momentum, quality, and defensive. This chart just shows that Quant Strategies figured this out a long time ago. It's very rare to find a quant strategy that does not tilt towards one or more of these factors. You can see that in the top heat map, that on average, a lot of these strategies have one or all of these factors. Fundamental active managers are a lot less consistent in this area. That doesn't mean that they can't generate alpha. It just means that if you want to build a portfolio that has positive exposure to these risk factors, you're probably going to have to utilize some quant or smart beta strategies. You're probably going to have to move outside just traditional fundamental active management. At Texas Teachers, we are fortunate enough to have the resources to have an internal quant team. They are not going to probably be able to compete with the biggest, baddest quant firms on Wall Street. But do we believe that they can build a factor portfolio that tilts towards these things? Absolutely. And that's a critical role that they play at Teachers. Okay, so if you believe that active management works better in some places than others, and you believe that there are that there are factors that can generate positive returns, and you have $150 billion to put to work, then what should you do? So the first thing that we did was to stop digging. So my boss, Brad, always says that if you find yourself in a hole, the first thing you need to do is put down the shovel. And for us, that meant that we had to significantly reduce the amount of assets that we had in US-oriented active management. We brought this down by $12 billion, which is about half of the portfolio. And that included completely shutting down our internally managed fundamental US equity portfolio. A lot of that money went to, like I said earlier, our internal quant team that was doing more factor-based investing. And we did retain relationships with our highest conviction external managers, but we do currently have about $4 billion sitting in passive while we kind of formulate our game plan on what to do going forward in the US. So we haven't thrown in the towel on US active management, but we did have to kind of acknowledge the results, acknowledge the data that we saw, and essentially put down the shovel. So that's the first thing that we did. The second thing is stop swimming upstream. And this relates to the factor exposure that we talked about earlier. If historically we only had a risk system that required us to not bet too far against these factors, we now consider these factors to be a very important component of the excess returns that we're trying to produce, and our portfolios are required to maintain positive exposure to them. One of the biggest things that helped us do this was the reorganization of our public equities team. So historically, our internal team and our external team were completely siloed, building portfolios that were completely unaware of each other's factor exposures and capabilities. We subsequently brought all of our public equities under common leadership and a common portfolio construction methodology. And that allowed us to let the quant team focus on building factor-oriented portfolios and achieving this exposure for us. And it allows my team, the external manager team, to be a little more factor agnostic and source active managers who are providing differentiated sources of alpha. Which leads to the last action, which I will call, don't hire a clown to fix a leak in the roof. So if we have the capability of building factor-based portfolios, the last thing that we want to do is hire an external manager who's only building a factor-based portfolio. That would be like hiring a clown to fix a leak. And so my team, like I said, has become a little bit more focused on sourcing differentiated sources of alpha. A classic example of this is a lot of value managers believe that their fundamental research is the main component of their excess returns. And that may be true for some of them, but if you look under the hood for others, you'll find that a simple factor-based strategy might generate the same return as they did. And like I said, those are the types of managers that my external team is looking to avoid, because we don't need to pay people to do that. We can do that internally. So that kind of leads to the logical question of, well, then what is considered a differentiated source of alpha? And there's lots of answers to that question. A couple of examples where we still believe things work. One, traditional stock work does still work. We still do believe in it. We think it is more difficult in efficient markets like the US. We think it works a little bit better in international markets. But there are organizations that have the resources, the experience, and the discipline to execute a traditional fundamental stock picking strategy that works. So we do still believe that works. We believe that there are some great quant firms out there who are competing with Google and Facebook for talent, and that these teams have the information and the data and the resources and the talent to generate alpha even in the most efficient markets like the US. One of my personal favorites is specialists operating in less crowded or less efficient markets. So this could be a strategy this could be a Japan specialist strategy, a European specialist strategy, a China A-share manager, a healthcare fund that has a specific expertise in biotech or something like that. And so that is another place we think it works. We also think, I know activism is kind of a dirty word, but people who can create their own catalyst, create their own value, we believe that they're capable of outperforming as well. So those are just a few examples. So in summary, TRS believes in active management. We just think there are nuances in the active-passive debate that we have to be willing to acknowledge, like active management working better in some places and us having to potentially utilize more factor-based strategies in other places. So thank you very much.